Nicholas, Wealth Management CEO and founder David Nicholas. David, I want to get your reaction to not just what we're seeing this morning with this one stock, United Health, hurting the Dow Jones futures, but also that sell-off yesterday.
Yeah, so it was a double whammy, right? You had Jerome Powell come out and say he's not going to support the market given what's going on with the volatility. But you also had, right, the administration come out and say that NVIDIA is going to need a license to ship these H20 chips to China. So that NVIDIA essentially wrote this down to zero. But again, I'm not as concerned for NVIDIA. This was a separate chip that was built just for China. They're going to be okay. I think investors use this as a buying opportunity. But I think we're seeing some good news come out of Japan, right? I think the market is going to be watching this closely. I think other nations are going to be watching talks with Japan closely as a test case as how to make a deal with this administration. But Cheryl, we also have to notice what they're trying to box out China. And I think this is ultimately good for the world. You know, when China came out with their Silk Roads initiative, they've been preparing for this moment for the last decade. And so nations are going to have to make a choice. Do I want to partner with a communist government going forward, or do I want to try to partner with the U.S., which will unlock and open up new opportunities? So this is a big deal. We need a good deal with Japan. We need a good deal with England, Europe, India. We have Italy coming to the White House. The market's going to be watching this closely. That's what the market wants to head higher.
The volatility, though, I mean, if you look at last week, 98 billion shares exchanged hands last week between the NYSE and the Nasdaq. That is an incredible amount. And you know, with all three major indices down by about 6% and this volatility continuing, you know, I think the question here is how much patience do investors have? I mean, it seems like a lot of the norms that we know aren't really viable, and because we've got unprecedented times, frankly, for the markets with the tariff fight and the trade war with China.
Yeah, and this is you got to decide, are we investors or are we traders? And so it's going to be very hard to trade this market, meaning why? Because the market is being driven by one person, and that's the president of the United States, and what deals are going to come out of D.C. If you can give me a way to trade that market, it's near impossible. This is why you want to stay invested. If you have some dry powder or cash to put to work, buy on down days, but you are not going to be able to time this market perfectly because it's news driven, Cheryl.
Sure. Mark Tepper, jump in here.
Hey, David, good morning. Look, I got a question for you on what kinds of communication, what kind of conversations you're having with clients right now. Is it it's time to get more defensive? Is it's time to rotate from defensive positions into more growth-oriented stocks? Is it, hey, maybe now is a good time to do a Roth conversion since your 401k has become a 301k? What kinds of conversations are you having with clients right now?
Yeah, Mark, it's a great point. All of those points. So one of the big things is, depending on who you are as an investor, if you're someone that's in retirement, you should have an income bucket. And that income bucket is there to provide income. It's there to provide safety. But you're spot on. For our viewers, Roth conversions are one of the best things that you can do when the market is down. So we're telling our clients, look, NASDAQ's down over almost 20%, S&P's down 10. Use this time to take money out of taxable IRA accounts. You pay the tax today, but remember, Mark, taxes are at 50-year lows. I'm good with paying taxes today. I can convert that to a Roth. When the market comes back, and it will, all of that growth is tax-free. So those are some of the things we're telling clients. But if we have rallies, we are telling our clients to shift to lower beta stocks. Why? Just de-risk a little bit. You still want to stay invested, but maybe not have the high beta stocks if we get some rallies.
Well, you know, look, I mean, all this market volatility that we've been dealing with for most of the month of April, you know, Americans get confused, you know, especially those that are getting near retirement age, David. So what is your retirement advice in this market, in particular for those clients that were hoping to retire, say 5 years or less?
Yeah, so the big thing is about positioning, right? If you're someone that's 5 years away from retirement, look, I love Wall Street. It's a great way to build growth over time. But the majority of your money, if you're within 5 years of retirement or in retirement, shouldn't fully be invested in equities. Like I mentioned, you've got to have a piece of your portfolio that's fixed income, that's providing dividends and interest. If you're someone in retirement, 40 to 60% of your portfolio should not be impacted by the craziness that's coming out of Washington or the rest of the world. So you got to have that income bucket in place. But also, it's a mindset shift. I know we know this, but in retirement, our income is going to stop one day. It's like we know this, but it's really hard to process. Our income will stop one day, and all of the money that we saved is what's going to carry us through. So we've got to make sure we're allocated correctly, Cheryl.
David Nicholas, great to see you. Thank you for being here. Another crazy day at the office. Appreciate it, sir.
Yeah, thank you.
All right.